You're about to listen to the Yet Another Value podcast. Today's episode is with the team who won the Pershing Square Challenge. With their pitch was Carlisle. It was the 18th annual Pershing Square Challenge, and I believe this was the first team to win it unanimously. They're super smart. It was a really interesting conversation. They did fantastic work on it. So I think you're really going to enjoy it. And, these guys are first-year Columbia MBA students. So if you want to reach out to them, there'll be a link to their presentation in the show notes. I'd encourage you. I think they did fantastic work. It's a great conversation. So I think you'll really enjoy it. That's coming up. But first, a word from our sponsors. This podcast is sponsored by FinTool. Look, those of you who have followed me on the blog, on the podcast, know that the two areas I've probably thought the most about over the past couple of months is AI and corporate governance. And look, if you are not using AI, you are getting left behind. And let me just marry those two thoughts in one way. If you read through proxies, there's one thing that you know. Proxies contain a lot of information, but they suck. Companies are almost intentionally obfuscating and burying a lot of the interesting information here. Guess what? You can use AI to really cut through the noise there. So FinTool just released a thing. You can go do a deep dive into every person in a company's executive roster. So, if I'm looking at a company, I can go to the FinTool people tool. I can look at their CFO and I can see, hey, here's exactly how much he's paid. Here's everything that he's done. Here's everything that's been included about him in the proxy for the past 5 years. Here's all of his key incentives points summarized, laid out so that, what used to take me a day of going through 12 different proxies and looking and matching and saying, was he on this board? When did he join this board? It takes 15 seconds. So look, go check out FinTool, start using AI. You are going to get left behind fast if you are not using AI as a fundamental investor. FinTool, they really interesting product and it continues to evolve. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have the team that won the Pershing Square Challenge at Columbia. The 18th anniversary, 2025 Pershing Square Challenge. Team Carlisle, the ticker there is CSL. We're going to be talking about all of that today. I'm going to turn it over to you guys to introduce yourself. Before I do, quick disclaimer, remind everyone, nothing on this podcast is investing advice. There's a full disclaimer at the end of the episode. You can listen to that if you want. So Team Carlisle, you guys won the Pershing Square Challenge. All of you are first years at Columbia Business School. Congratulations on winning. Congratulations on that. I'd love to start this podcast if each of you could just give a 30-second overview, who you are, introduce yourself, a little bit of background. And Erik, you're in the top left of my screen. So Erik, do you want to go first?
Sure. So my name's Erik. I grew up in Florida. I moved out to Texas to start my career at a startup. I was there for a little bit under 2 years and made the switch into an investing role. I worked for Andy Beal at CSG Investments for about 2 years, did distressed debt investing, and that got me to Columbia. And so at Columbia now, really just been taking all the investing courses. That's how I met these guys, and been interning at Owl Creek Asset Management over the spring. And this summer I'll be at Rothschild doing restructuring.
God, what a terrible, terrible background. Awful mentors, awful history, just the worst. Now you're at an Ivy League business school. Dimitry, do you want to go next?
Sure. I'm Dimitry. I was born in Russia, moved and grew up in London, and then came to undergrad to Chicago. So I studied in the US once before. And I was quite lucky. I joined a buy-side rotational program at a small Swiss bank, first in London, looking at international non-US equities. And then for 1 year before my MBA, was in Geneva, working for a sustainable fund. And then came here to, find the right kind of philosophy and opportunity for me to go forward.
Fantastic. And Tuan, do you want to wrap it up?
Sure. So my name's Tuan. Also, like Dimitri, I was born and raised in Russia and then moved to the Vietnamese family, but moved to the US to pursue a professional career in tennis. Then went to school in Boston, went to BU, Boston University, and then shortly after came out of school and spent a few years in hotel private equity, and then made a pivot to corporate strategy at a grocery retailer. But throughout this whole time, kind of found my passion in investing and Ben Graham and Buffett in college, so knew I wanted to pivot into investment management at some point. So Columbia was kind of, I set my sights in Columbia about 8 years ago. So right now it's kind of living that dream goal, and really excited to both be in this program and just exploring the career path in investment management after school as well. So
that's awesome.
for having
My
us.
wife also went to BU, so go dogs. It's Bulldogs, right? Terriers,
Nice.
terriers, it's
Terriers. Yeah,
Yeah,
you got it.
there we go. Well, let's dive into it. So you guys won. I believe I was told that this was in the 18 years of the Pershing Square Challenge. This was the first unanimous winner in the history of the challenge. So congrats on that. I'd love to just start. Any of you can take it, but maybe we can just start with a quick high-level overview of, again, the ticker CSL, Carlisle Companies, what they are and what you found so interesting about them.
And Tuan will kick us off, and then we'll see if
Yeah, sure. Yeah, I can get us started. So at a high level, Carlisle is the largest manufacturer of commercial roofing systems in the US and provider of building envelope solutions. So at first glance, when people see building products, they'll tend to write it off as too cyclical, hard to own. But Carlisle is not as cyclical as one might expect for a building products company for a couple of reasons. First, Carlisle has 80% exposure to commercial, which, as history shows, is much less cyclical than resi. And second, high R&R, which is also less impacted by macroeconomic cycles, interest rates, and the like.
R&R, can you just quickly
R&R, yeah, repair and replacement. And now, not many people are aware of this, but commercial roofing is a very attractive niche to be in, not just in terms of building products, but in an absolute sense. So you have high recurring revenues, 70% of revenues R&R, high barriers to entry, strong profit margins. It's relatively asset light and has low capital intensity, and we can get into that a little bit more. Attractive returns on invested capital, and very sticky, long-lived customers due to the high switching costs. And then you also have a very laser-focused management team with a strong track record of capital allocation. So all of that makes it a very high-quality business. But for most of its history, this gem of a business was hidden as part of a complex, diversified conglomerate, which at one point had as many as 9 different segments and then 5 segments. And now today is a pure play, building products juggernaut. And the story behind that is the present management, CEO Chris Koch, took the helm in 2016. And over the past 8 years has kind of gradually simplified the business, selling off all the low returning segments and emerging the company as this pure play company here on out. And we think the big reason for the opportunity is it's been quite underfollowed for a company of this size. And it only sold off that last non-core segment, CIT, in May of last year. So historical financials are still quite noisy, very easy to miss if someone's just doing a quick screen on Bloomberg. And so, with that, we think Carlisle's very interesting at these levels. It obviously was a bit juicier when we pitched it in the 350s range. Now current price is about 400, so we think intrinsic value range is closer to roughly $600 per share. So we think IRR has come down a bit from the low 20s range to the mid to high teens. But we're still excited for the road ahead. So maybe I'll pause there. See if you guys have any questions. And
mid to high teens, mid to high teens return is nothing to laugh at. Erik, Dimitry, I'll tell. Just, is there anything that you guys want to build off of what he said on the background and everything? There's a lot of stuff from, I've seen your deck. I've got a lot of questions of the company, but anything that Tuan said that you guys want to build off there?
Yeah, I think maybe Dimitry can add to this, but we knew we were going to team up before the class started. We were all hoping to get a head start on this whole thing. And we spent all of our Christmas break sort of looking into different names, looked at hundreds of different companies. And maybe Dimitry can kind of wrap it all together and tell you how we arrived at Carlisle. But this was a lot of work. And we found this company really not expecting that this is what we were going to end up spending 3-4 months on.
I'm just a little jealous. You guys are the 3 amigos. You're like, we want to work together. And then you got to work together for an entire semester on a value investing idea. I wish I had that with my friends. Yeah, let's do that. I think that's great. Dimitry, do you want to talk about how you guys kind of settled on Carlisle, since it sounds like you had the team, you just didn't know the name that you guys were going to kind of research and find?
Yeah, well, kind of as Erik was alluding to in our intro, we took a class called Advanced Investment Research altogether, which is one of these flagship competitive classes at Columbia taught by Kian Ghazi. And we were a bit inspired by what we went through there. So we had 3 idea generation pillars, and we have a slide buried deep in our deck that kind of goes through exactly how this worked. But one of our very simple funnels was we were looking for basically good companies that can generate some kind of decent return on capital that had a share price reaction in the last year or two. And what Professor Ghazi was teaching us is one way to have a very productive project where you're less likely to end up neutral is to hunt for nonlinear changes. So nonlinear changes can be, anything from kind of the actual stock price movements to something in the industry. And in the case of Carlisle, what grabbed our attention, as we started reading more about it was, what Tuan was talking about, the portfolio simplification and the industry pricing change. So then a second funnel, and really, Tuan was the champion of this idea, was going through the Value Investor Insight articles over the last decade. And Carlisle was mentioned there a small handful of times, but was always, a footnote in kind of a longer debrief on someone's strategy, or was not really the main focus of different people's portfolios. So we kind of saw it there, and then between those two and then the last funnel of trying to think about the Pershing Square portfolio and interest categories. For us, we didn't want to pitch something very obvious, but we knew they would like a brand name, they would like something with a good competitive position, and Bill Ackman has a family history in real estate, and obviously there's this QSR angle to the portfolio recently, and sort of a royalty theme. So we were trying to think of a few ideas where, in a less obvious way, you would be getting a royalty on some of the things that they already like. And something that wasn't part of our thesis, but that we came across, was when you have a franchise restaurant opening, the roof of that restaurant is also actually highly specified, and it's not like you have free choice to pick whatever material you would like. And so if you like that theme and you think there's going to be more and more openings, that could have been an initial angle on why to get excited and get interested.
I love the game theory of, you guys found an undervalued thing, but I love the game theory of, you knew who the judges were and you wanted to design a pitch that one of the judges would be really useful. Look, if you think about like Sohn, as people have said, the pitches at Sohn tend to be extremely cyclical, where, when AI is hot and AI is the winner, and when event driven is hot, when I won it a few years ago, event driven was hot, so an event driven trades the winner, and it tends to be cyclical. I love that you guys just played to the judges. There were a lot of things. Go ahead.
Could I add one other thing? Because maybe to de-emphasize the game theory aspect of it, taking all of that.
It's a great idea too, but I just like that you kind of had that added edge.
It was a nice, extra, but overall it also fit in the framework of, which of the, few ideas we kind of had a handful of, they seemed to cluster around certain themes, but this one really had, multiple potential IRR drivers. And we're a team of 3 guys, one of whom has been living on a construction site for the last year at Columbia. So it seemed like we'd have a small edge in terms of doing kind of this value-added research and outreach to get a new angle.
So I have a lot of questions, but I want to start off by highlighting, if I was judging this, and I have judged things like this in the past, if I was judging this would have been the slide that I would have been like, oh, instantly these guys are like high finalists, all this sort of stuff. You guys talked about the summary of unique work you did. And in particular, I was looking at, you went to 3 different, it could have been more, but you went to 3 different trade shows. I've got a roofing show in San Antonio, New York Build in New York, and then the roofing contractors in Jersey. And I would have thrown you to the front of anything judging, just because you guys went out and did that. So I just want to ask about all of the extra research you did. And that's not it. There's a lot of others. Like towards the back, there's the photo of you guys with the hard hats, which I'm glad you're investors, not executives, because it's a red flag when you see the executives with the hard hat. But I'd love to just quickly ask you about the extra research you did, and also, I have been thinking a lot about going to trade shows, and we can talk why longer if y'all want to go into a more philosophical discussion. But I'd love to hear about kind of when you guys go to these industry shows, what you were learning that kind of maybe wasn't jumping off the page when you were just reading a 10K or listening to a conference call.
Maybe shall I kick us off and try and keep it brief? But, one other aspect that attracted us to Carlisle is, the top 4 players that control the market. 2 of them are private, and you don't really have all that much information. Carlisle has been going through this business simplification. So, historically, you really need to dig out the right data. And Holcim, the number 2 player, is actually a European conglomerate, and this is just one business for them. So a really great way for us to get a proper understanding was to go and talk to the people at the trade show from each of these companies and also the people across the value chain who are interacting with them, and make sure we're, understanding the information that we're finding in Google and in other creative ways correctly. And even things like market share, there's a lot of different ways to slice and dice this. But I'll pause there.
One thing I'll just touch on, Andrew, is the class that we all connected over, investment research, calls for students to reach out to 15 people in the industry for a particular name. And in that exercise, we scoured LinkedIn and for me personally, 400 connections, and only was able to get maybe 16 calls. And even then, it's a very, manual and tough process, taking many weeks. But with the experience of actually going to these trade shows, at least personally for me, I found that the ability to find this differentiated research was just way more efficient. You're able to talk to so many more people and build these relationships that you can actually follow up on and continue nurturing that relationship over time if you're deploying a company or industry. So it was absolutely huge.
Erik, if you want to add anything to that, why don't? Question. Go ahead, Erik.
I was going to say, you asked, how did this help us to get beyond the 10K? And I think that for me was pretty much the experience at the conferences was very substantial in bridging the gap there, because you read from their investor deck or their website, and they're saying these things that if you aren't working in the trade, you have literally no idea what they're talking about. And it almost sounds like they're just making words up to fill up space on the page and just seeing what sticks. So there's this concept that they were really hitting a lot on, which was like labor savings. They were trying to market that their products were saving money on labor. And I was like, how exactly does this work? How does this experience that they're selling really fit into reality and what these contractors are experiencing? And so when we got to the trade show, especially the one down in New Jersey, we were able to talk to contractors. We were able to talk to people across different companies and really understand what these things meant and get a tangible sense for what these products are, why they're actually different, and why they actually have value. And I think that we were able to speak with the management team later on and actually communicate kind of the gap there. And I think that's one of their concerns, is that it's difficult to communicate these themes unless you've been there, unless you've experienced it, unless you've talked to people actually in the field.
And this is a highly relationship-based business. So one anecdote is, I remember Erik and I were at the Atlantic City show together talking to one of the contractors. These are not people who are going to be writing in a 10K about how they have, a family history of working with a specific brand and how, nothing would compel them to change, having gone through generations of that. That's not something you can get otherwise unless you really go there and see it sort of firsthand explained to you.
That actually transitions perfectly into the key question I had when I was reading your pitch, when I was reading the calls. If you guys came to me, and I think Tuan mentioned it during his call as well, if you said, hey, I've got a building products company, it sells commercial roofs, I would have been like, okay, cool. I'm going to guess 8% margins, and return on equity through the cycle is volatile, but basically cost of capital. And that is not what's happening here, right? Obviously a little bit of cyclicality, but they will point and say, hey, did fine during the GFC. Their target 2030, I believe their ROIC targets are over 25%. This is a business that is generating incredible returns on capital, great growth, a lot less cyclicality than I would drop. Dimitry, you mentioned, hey, we talked to a construction product guy who he'd been working with the company for generations. And when you listen to the company talking about, they'll say, hey, this company that we just bought was started in the 1860s. This one was started in the 1920s. Why is this business, why is this good? Just why is it good? Why does your guy who's been working with them for generations, why isn't he working with them this year? And the next year, some other roofing products calls him up and says, hey, we'll give you everything, but we'll give it to you 3% cheaper. And he says, that's 3% more in my pocket. Let's go, boys. Why is this a good business?
I think I can talk about this all day, but probably Tuan has a more concise answer than me. So I'll let him kick off.
We've got an hour. Ramble.
Yeah, and I mean, I can start. I think at the end of the day, when it comes to the stickiness at the contractor level, you have a couple components. First, you have the certification and the training that's required to actually install the product. It's a very technical product with these commercial roofs. And you and I, can't just go out and start buying Carlisle product and installing Carlisle product on roofs. You have to go through a certification process, and you have to demonstrate that you can actually install these roofs reliably and build a track record. And we can get
the person getting the certification. Is it the general contractor, or is it each individual laborer who's getting certified?
So if you think about a typical building project, you've got the general contractor, but then you've got the roofing subcontractor. So in this case, it's the roofing subcontractor that gets that training, and then he in turn can also hire a bunch of other subcontractors that do some of the labor for him as well. But at a high level, there's that certification training component. And then what you'll find in the case of Carlisle, as an example, is they have different brands under the Carlisle umbrella, like Versico and Mulehide and Carlisle Syntec. Carlisle Syntec being the highest brand, and they kind of, in a sense, segment the contractor base in that respect. And as you prove your mettle, you climb up that brand ladder within Carlisle. But that's one key component.
What does a roofing subcontractor decide to go with Carlisle versus someone else? Is it just, hey, when I was the JV under the other subcontractor, I learned Carlisle, so when I go up, of course I'm going to learn Carlisle? Or is there like a bidding process? How does that happen?
There's a couple of things. I think Tuan was about to get to them, but maybe
sorry, go
ahead. Just taking a step back it's useful to understand a bit more tangibly like what this product actually is and what the point is, because it's a couple of very simple materials sold in a way that is combined that makes it much more technical than the underlying components might be. Because really the point is Carlisle is selling this fully warranted system that consists of a bit of insulation, the TPO layer, and the accessories. And they're guaranteeing the system for the next 20, or these days could be up to 30 years. So if I'm a customer, like I am really worried about if something goes wrong, who is responsible and who can I, charge and go to this for technical support. So typically the contractor takes the first couple of years of the warranty on themselves and on their shoulders, and then Carlisle or one of the other top four who produce all of the components themselves in-house, they're able to guarantee that whole system for this enormous amount of time that is the full life of the roof. And that really is step one of separating these top four players from the next ones who are sometimes white labeling from the top four players, and as a result the warranty might look similar, but actually any interaction point becomes like a big point of contention. So that's one of the pulls of this brand. But maybe I'll pause there for a second in terms of how the actual bid works and so on.
Yeah, I'd love to understand how the actual bid works. That sounds great.
I mean, I'm happy to continue unless you
go for it.
Yeah, so we had, so as you saw, we spoke to a lot of different people. Maybe one very specific, tangible example is we spoke to the director of trades at Columbia. So Columbia's two business school buildings have Carlisle installed on the roof. Mm-hmm. So the director of trades, who actually 2 years ago was also, before he came to Columbia, he was in charge of Capital One's building and roof portfolio, which is like 500 roofs across the US, and Columbia is 300. So, not necessarily a representative sample, but quite a big one. He would have usually two approved vendors on his approved vendor list that he would choose from by default for a project. That said, you would have some kind of competitive bid process at the point when you need to re-roof, and you would solicit some information from some other players, but really 80% of volume would go to the top one player and 20 would go to a second kind of backup option, which actually would not even necessarily be one of these top four and could be a more local player just to build some redundancy. So it's very, very sticky from kind of the customer side for a commercial customer like that, but also from the perspective of a new build, the architect or engineer, they have a spec sheet where they know certain brands they've worked with before that have this, potentially decades long track record of what can be installed on the roof and how it's going to interact with other parts of the building. And to disrupt that and come in, that's actually a really difficult process and requires, challenging the architect's current work stream and way of thinking. And we have a potential anecdote there as well, if you like.
Yeah, hit me with the anecdote. I'd love to hear it.
Does one of you guys want to talk about ICO trying to enter the market?
Go for it.
Yeah, and well, I can touch on ICO. So ICO, as brief background, is a Canadian Canadian manufacturer of roofing materials, and they were more focused on the residential side of things, but they decided to enter the commercial roofing materials market in about 2021 timeframe. They've had one facility, and they've been trying to take share from the market over the past, call it 3 to 4 years. And based on all the conversations that we've had at these different trade shows, it seems like they still haven't gotten serious traction, and that kind of speaks to how difficult it is to actually gain share, not just in these, re-roofing projects, but especially these new build projects that Carlisle, Elevate, and the other top 4 players actually compete in. So, for a new entrant to actually enter this market and take some of these excess returns can take, in our view, years, if not up to a decade or more.
So
and just
unless you buy yourself in to the spec sheet.
Yeah, but also the extra color here is, this is not just some random, small firm.
Yep.
These guys are highly visible at these trade shows. They're advertising. They've taken, veterans from the top 3 players and brought them into their business. And they've been trying to undercut price. And basically, they cannot actually compete for the same fully warranted projects that Carlisle is doing, even despite all those things.
So if I'm listening to you guys correctly, it seems like the major moat here is, it's almost brand, right? It's, hey, the warranty costs, and everybody, like, I'm from New Orleans, everybody knows hurricanes come through, and what's the worst thing? Obviously, if water gets in your home, that's worse, but the roof is damaged and you got to call the insurance guy, and a roof is, I think it's 5 to 10% of a building's cost. So like, that's material if the roof's getting damaged. That's where most of the damage is happening. So it sounds to me like the warranty and just knowing that these companies are going to be there 20 years from now to handle the warranty is the big thing. I guess that makes sense as a moat, but the contractors have to get approved. But do contractors they only work with one of these big 3?
It depends how big the contractor is. So for a smaller contractor, it's not the most simple process. I mean, if you're larger and you're making enough money on an aggregate basis, you probably are contracted with all of the top 4 and maybe a couple more, but it really depends. But what I was going to get at is you have this brand and kind of relationship aspect, but you also have the incentive to concentrate volume. So you do get a volume rebate. This product doesn't travel super well. And historically, there's these anecdotes about trips to Hawaii that Elevate would give to its top 500 master contractors. And if you want to be making the most of the sales incentives, you're not really diversifying across more than 2 or 3.
That's a really funny moat. Hey, it makes sense, right? The more I hear about Salesforce and everything, like, you concentrate, you hit the volume, and you're going to get a free trip to Hawaii. Okay, I think that makes sense. We might return to the business, but let's talk valuation real quick. I think the second thing, and I'm just pulling up my notes, people are going to look at this, and the first thing I thought was, hey, I can't believe that this is a good business. And I think you guys and the numbers, you guys have suggested why it is, and the numbers are proving why it is, right? The second thing I would say is, hey, why is this an alpha opportunity? If I was looking at valuation, I'd say, hey, if I went back to 2019, now they've divested some of the lower margin businesses, but margins are definitely up over the past 5 to 7 years, right? Margins have gone up. I think if I kind of backed out the lower margin business they've probably gone from the low 20s to the high 20s. So you've got margin expansion, and they're trading at, call it 20 times this year's earnings, 16 times next year's earnings. So I'd say, hey, you've got a still somewhat cyclical business. It's trading for a full multiple. Its margins are at the higher end of what they've earned. And then, by the way, this is a business that has done a lot with acquisitions. And at this point, this is a $20 billion company. Last year, they did 700 million acquisitions, 700 million acquisitions. It's starting to get to the point where there's not a lot of acquisitions that budge the needle anymore. So if I just threw the three of those out there, I'd be like, oh, interesting business, good business, but is it alpha? So any of you can start and you can break down any of those points you want.
Yeah, I think maybe we can touch on that. The biggest pushback that this company has had in terms of the bull bear debate, if you will, is, are margins going to sustain, or are they going to mean revert? And so with the current, when we were looking at it, the pricing, what the current price was implying in terms of revenue growth and margins, it showed that revenue was going to be below what management was guiding, which was 5%, and margins were going to stay about flat over the ensuing couple of years, maybe a little bit increase, and then drop off dramatically. And that was partly due to the limited analyst coverage going out 3 years. But that was the key question that we were trying to answer.
The interesting thing is, because this is not that well covered, there's a few different ways you can think of what is actually priced in. So we were looking at consensus and could see that right now for this year, they had very weak organic growth, and then over the next couple of years had margins kind of coming down. But part of it is also because of analysts dropping out of consensus. So it's not super helpful. But then we also looked, as Tuan was alluding to, we did our own reverse DCF and tried to triangulate, okay, if we put the consensus numbers, what do we get if we kind of stretch this out into the next couple of years explicitly? But I think the overarching point is that you're buying a company that has very, I guess, relatively predictable growth characteristics, and what we felt was a resilient margin at a multiple, which at the time was, I think, 16 times forward earnings compared to an S&P average that was meaningfully higher. And on top of that, this was kind of the US listed pure play champion for this category and trading at a lower multiple than other conglomerate building product companies listed in Europe, which is quite an unusual
yeah, trading below maybe over the past month, but the most frequent theme for investors over the past years has been, hey, this European pure play trades at a 50% discount to the Americans. Let me frame the investment another way. The stock, as you and I are talking, is trading for 400 per share. They give a target 2030 EPS number, right? The target 2030 EPS number is $40 per share. And on the Q1 call, they said, hey, we're going to generate, I'm looking at it, $6 billion in cash flow between now and then. That's about $133 per share. So if I said $40 per share, what multiple would you put on a 2030 earnings number?
Yeah, that's the big question. But I think our exit multiple, we assumed 18, and we're still able to get an attractive IRR. But a case can be made here for, if you were to look at this business and take stock of their advantages in distribution, their underlying economics, and just historical returns, and their just competitive position and market share leadership in the industry. Can you argue for a low to mid-20s multiple on a business like this? I mean, we had a slide in the deck that touches on some aspirational comps, like Sherwin-Williams comes to mind in terms of control over distribution. Company like Kingspan, also a very good operator, which we can touch on their interest in entering the U.S. market, commercial roofing as well.
Sika, who's traded a crazy multiple, whose
exactly.
CEO is now going to be leading Holcim Elevate as well.
Right.
No, look, I had just done 15 times $40 per share, get you to a 600 stock price plus 133 in cash build between now and then. That's 733 stock price against 400. That's approaching 15% 5-year IRR.
So you're getting to where
that puts you in that puts you in the top 2% of investors. Yep. Erik,
this is exactly the point.
These guys are covering it well. Sorry, go ahead, Dimitry.
Yeah, I was just going to say, so even though you can put an aspirational P on whatever you like, actually, we realized you don't even need to do that because, as you mentioned, keeping the P constant, the cash build that they should be able to do, if we're right, will enable management to buy back a significant amount of shares in the coming years, which will then get you that, same IRR quite easily, even without it. But sorry, Erik, go ahead and add if I'm missing anything here too.
Oh no, you're good. That was one of the main points that we were really eager to bring up whenever anyone would push us as to, okay, so great, you've got a good opportunity here. When is it going to materialize? What are the catalysts? It doesn't really matter for us how long this takes to be materialized, because management is committed to continue buying back, and you're just buying more and more of a good business that other people want access to but can't break into. So we think all else equal, the excess cash is going to be deployed intelligently, whether it's through M&A or buybacks.
It's funny because I have always said, oh, if the price goes lower, it's great. The management teams, they're going to buy back shares. And then maybe it's because I'm investing in worse management teams. The buybacks when the stock's at 100, my God, do they know how to buy back stock? And then the stock's at 60 and they're, you know what? We don't know. We don't know. So that actually kind of transitions nicely into management. I'd love to talk about, you guys, I saw your deck, you hit on the first thing I hit on as well, but I'd love to quickly talk about how you view management, how you view their track record, how you view kind of their alignment and incentives here.
I'm happy to talk about alignment, but someone else should start. Otherwise, I'm talking to
I mean, I'll touch a bit on the context behind this. So this management team, and specifically CEO Chris Koch, he came into the business to Carlisle in 2008 and then assumed the helm as CEO in 2016. If you look back in 2016, this business had 5 disparate segments. They had fluid technology segment, which was selling into medical and automotive. They had a food business at the time. They also had CIT, Interconnect Technologies, which was a cable business. So on the earnings calls, you would have them talking about commercial roofing in one segment, and then start talking about how they sell into Boeing. And so it was a very Frankenstein type of conglomerate that was very difficult for outside investors to understand. But since beginning of 2016 and kind of going forward, Chris Koch, he was very sensitive to the fact that you had this hidden gem of a business that was just year in, year out churning, putting up 20% plus ROICs year after year. So he slowly started adding bolt-on acquisitions to that building product segment, buying insulation businesses, and kind of building upon the position in the building products industry segment. And then, fast forward to 2020, 2021, the funny anecdote that we actually learned directly from him when we were talking is he received The Outsiders book by Bill Ruane and William Cunniff. I forget the first name of Cunniff, but Cunniff's daughter gave him Outsiders. He read that and he was like, oh, wow, that's exactly, he just had that light bulb epiphany. And since then, he just put all his chips into really focusing in on getting rid of the low returning, low single digit business segments and doubling down on that building product segment. So
that is so funny. And I will tell you my history with CEOs who I will not name names. My history with CEOs who are like, I read The Outsiders and I treat it as gospel, is either the stock is a grand slam home run or it's like this stock is going straight to zero, and the whole way they're going to be saying capital allocation, we're so aligned with shareholders. But I do think the results speak for themselves. And he owns $100 million in stock plus options. I have a strange question for you. Or does anybody want to say what I was going to cover? CEO and management? Go ahead.
Yeah. So, like we heard this story about The Outsiders, and as you say, it does look like the track record it aligns and is indicative of something interesting going on. But one thing to say is like the incentive design, could do with some improvement and be more explicit in our view. But that said, as you're alluding to, for a roofing company CEO, both Chris and Kevin own a significant portion of their total net worth in Carlisle and have held it for a very long time, which is also partially what helps us feel more confident that they're aligned with what we as a potential owner of this business would want to be doing. And combined with this return-oriented focus and ability to buy back shares and willingness to do it, it really kind of all goes hand in hand.
Let me ask you a weird question. And this is just something I've been thinking about. So it's not indicative of the company, but it's something that's been in my brain. So I want to get it out into the world. It's strange here because a lot of times I will see boards, a typical board where there was a private equity owner or there's a big long only fund. So the management team will own a middling to normal amount of stock, and then the board will have one or a few members who own quite a bit of stock, right? What's interesting here is you've got a CEO who owns 100 million plus of options. The management team up and down owns a decent bit of stock. Now, part of that's because the stock's done so darn well that it's become a decent bit of stock. And the board, to my memory from looking at the proxy, owns almost nothing. And I think it's interesting when you've got a management team that owns a lot of stock and a board that owns almost nothing. I think that's really good alignment, but it is a strange thing. And I was kind of thinking like, hey, are there risks where the board is asleep at the wheel? I think the management team still got it under control, but I thought it was just kind of interesting, and I wanted to throw it out into the world because I've been thinking about corporate governance from all sorts of different angles.
Yeah, I think, we're not as fresh on this as when I first did the review, but we did look into the overall incentive design across, both CEO, CFO, and the board, and, the overall components that they are targeting and the metrics do broadly make sense, although they did get rid of ROIC a few years ago. That said, I think there is also a function of a few of the previous, leading C-suite executives would step up to the board, but because they had spent like their whole life at the company, they would either retire, sort of 2 years after or something along those lines. And I'm pretty sure those kind of people, like I think the two former CFOs before Kevin had been on the board and would have owned a greater portion of shares. And I think it might just be a kind of a function of this kind of, transitioning from where you actually find these people and how many real roofing executives you can get who have good experience in the relevant places to put on the board too.
Let me 2030. I've mentioned target 2030. I believe they did a target 2025, and I think before that they had target 2022, if I remember correctly. They've hit their target so far. So I just want to ask on target 23. I think they're 2 for 2, but what are the odds you think they hit target 2030, and what do you think they kind of need to do? Like, what are the key drivers to hitting that target?
Yeah, I think I'll start. I think there are a couple of components. One, obviously, on the organic revenue front. I think, they've targeted that 5% organic revenue growth. I think from our view, and in talking to them as well, I think it's on the conservative side of things in terms of organic revenue growth. Accepting a recession, if we were to have one, that might dampen both new build and re-roofing to some extent. But keeping that organic revenue engine through 2030, the second layer of it, I think, is on the M&A front. And obviously they've shown a track record of doing accretive M&A in the past, especially over the past 6-7 years in the building product segment. So I think that if they can continue to find good bolt-on acquisitions in insulation and architectural metals to round out their roofing system and building envelope solutions, that can add another 2-3% potentially to the top line. And then you have buybacks in the event that stock price continues to not increase in any significant fashion, helping drive that EPS growth as well to that $40 per share range. But
I haven't read the Outsiders in the book, but they've demonstrated skill in bolt-on acquisitions. The management team got rid of kind of all the superfluous divisions. But one thing, if you've demonstrated skill in bolt-ons and you've got a passion for kind of buying, would there be a natural kind of larger than bolt-on deal? I don't know the commercial roofing space well enough, but it does seem like there'd be synergistic stuff that you kind of pump through the sales force or pump through your contractors. Do you think there would be a natural kind of bigger than bolt-on deal that they could look into?
I think one that they have done is the Henry acquisition, which maybe Tuan could talk quite a bit about, but this is something they've basically entered a whole new market. They've expanded their TAM substantially, and it's basically formed the basis of a new segment for their business. But yeah, these guys, they are very good at acquiring. They do it in a disciplined fashion. They do it logically in order to address different parts of the spec sheet. And they're able to pay on a gross basis anywhere in the low to mid teens. And when you consider the integration, they get the multiple down to 7-8 times on an EBITDA basis. They're disciplined and they're good at acquiring businesses. It's usually a pretty accretive thing for them.
The track record of over delivering on synergies, from what I can tell, is just insane.
Yeah. And Andrew, to flip your question actually on its head, Carlisle themselves have been the target of potential acquisition several times in the past. So Kingspan, who are now entering the market or trying to enter the market, they had considered bidding for Carlisle in the past, and they do more like wall insulation, and they're European-based at the moment. And they had been active in one or two other bid opportunities before. And as you might have seen in our deck and maybe read more broadly, like this could be a good question for Brad Jacobs as well, who's acquiring Beacon, which is one of Carlisle's major kind of symbiotic specialist distributors, and whether there could be, a chance for greater vertical integration there. But it sounds like there are good reasons historically.
No, it's funny. My last question was going to be Jacobs, QXO. They just bought Beacon. Beacon is their third largest customer, I want to say. Beacon's a big customer here. You can search through the filings. They've been mentioned a few times. I think on the Q1 call, somebody asked, hey, QXO and Beacon, what's going on with that? And I only ask because for those who don't know, Brad Jacobs, legendary entrepreneur, probably the only person to do 3 roll-ups and take them to over $1 billion. He just bought Beacon, a big customer here. Does Brad Jacobs moving to QXO risk, opportunity? How do you guys think about that?
Yes, this was my segment in the speaking notes.
Go for it.
So I'll kick us off. Initially we did think this was a potential risk, and one of these very unique risks specific to this sector and this company. We managed to find a podcast that Brad Jacobs was speaking on about kind of his plan and his vision.
Look, I've done 300 plus of these podcasts, and the only one who might have done more is Brad Jacobs over the past year talking about QXO. I think every other Odd Lots podcast at this point is Brad Jacobs.
Yeah, so we were listening to him, and we were trying to understand whether this can change this key relationship, because as you said, Beacon's a top 3 customer of Carlisle, and vice versa. Carlisle is a really important supplier to Beacon, especially on the commercial roofing side, because they also do resi, if I'm not mistaken. So for us, after thinking through it and talking to management, talking to people in the industry, it really comes back to the point that Brad Jacobs wants to accelerate M&A and accelerate the consolidation of distributors. But that's something that's already been happening, and it's just a question of the speed at which it can happen going forward. And secondly, he wants to, create cost savings and efficiency, and do it by essentially concentrating volume on probably the best relationships he has. And from the sounds of it, Carlisle, especially in certain regions, might well be even an exclusive supplier with Beacon and vice versa. So from that perspective, there should be kind of mutually beneficial, kind of synergistic benefits to be had from working even more closely over time. So that's probably our take at the moment, but it's something we would need to monitor and could evolve.
No, look, if you think there's reasons that I think the big 3 own 66% of the market. If you think there's reasons for the big 3 to own most of the market, then the best entrepreneur roll-up guy in the industry getting involved in one of your suppliers, there's probably risk of pricing pressure, but it's probably good because he's probably going to cut out anything he buys is going to cut out those mom and pops. Anything else on Jacobs? Or I had a few kind of other lingering questions.
Yeah, the one other big piece that I would add is the thing to understand here is the ultimate decision maker is the contractors and building specifiers. And so you have that demand pull. So yes, the distributor can extract better economics if they have more concentration, more volume. But at the end of the day, they're going to sell products that are coming off the shelves and are getting demanded by the end customer. And in this case, Carlisle has a very sticky customer base that will year in, year out ask for Carlisle products. So as Dimitry mentioned, Beacon is a very big customer and partner, because in this case, the way that the value chain works, the distributor and the manufacturer work very closely to sell this technical product to the end customer. And distributor employs a markup pricing model, so they're not very incentivized to necessarily have pricing be lower. So if you take all of that into consideration, we think that on a net basis, Carlisle should benefit from increased consolidation in the distributor channel, especially with QXO accelerating that.
One of the nice things about you guys having already done this pitch and won a contest is I can lean on the wisdom of the questioners who came before me. So I'd love to ask, what was the most insightful question that you got when you did the first pitch, or just when you've been circulating this pitch into the ether recently?
Yeah, I think we got a lot of questions on, I guess, there's always the first question of what actually is this product and is this really recurring or not?
We already answered that one.
But once you get past that layer, it's really about the margins and how credible is this margin trajectory for the specific businesses they have today. And I'll let maybe the guys talk a bit more about that potentially, but we just felt we had many factors coming together that will point in the same direction, that it should be at least resilient, if not even have room for improvement. And that lined up with kind of the message that employees of Carlisle seem to be saying as well.
One interesting question was why invest in the manufacturers and not the distributors? And so, in this case, specifically in this industry, you don't really have that many options, either on the manufacturer side or on the distributor side. You just have Beacon as the only public player. You have SRS, which was acquired by Home Depot, so private, or you can invest in Home Depot and be exposed to all the other stuff too. And ABC Supply, the largest, and that's also private. So, in our view, if that was the question, I think the fundamental drivers of this industry are so attractive going forward that you can make a case to be invested. Why not be exposed to both and buy a bit of QXO and buy a bit of Carlisle? That was one of the other interesting questions that we had.
Erik,
there's two categories of people we would tend to talk to. There's the people who would, come from the perspective of, why did you guys choose to focus on building materials? How are you going to win this competition? Isn't there going to be a very high hurdle? And then the people who kind of are aware that there are these high value added building materials with good relationships. And essentially those would be kind of the two tensions we'd have to grapple with, depending who we're talking to.
Erik, if I told you, we laid out the 2030 vision, 700 stock price, 15% IRR. If we go into a global depression and we never build another building in this country again, off the table, and I asked you, what would be the thing that keeps you up the most at night if you were running a concentrated portfolio with Carlisle as one of your big positions? What would be the thing that keeps you up the most at night?
Yeah, the funny part about this question is that I was actually the guy who was trying really hard to kill this idea because I hated it at first. And I was really skeptical of the margins. Like, it's something where you have no track record really, unless you really we had to clean a lot of data. We had to really dive deep into the footnotes to figure out what the underlying business actually was. And until you're able to do that and understand going forward the strength of the margins and really the ability to sustain this high margin business, I think that kept me up a lot. That was something I was trying to use to kill the idea. And going forward, I think that's the most worrying thing about it all. And it would require a few structural changes that we don't necessarily see as too likely.
Give me a structural change that would kind of impact the margin story here.
So let's just say that all of a sudden people stop caring about pricing and people change the way in which they quote contracts.
If there's one thing the past 3 years have taught me, it's people really care about pricing.
Right. Yeah, no, exactly. And every single person is along the value chain is incentivized to keep pricing flat or higher. And that was something I didn't know from the outside. And so going forward, if I were to be, getting kept up at night by anything, it'd probably be, okay, all of a sudden everybody's going to stop trying to drive prices up. They're going to price off of a different model than cost plus. And we're going to get something like a whole new regime in terms of pricing. That would be something that really worries me, but I don't see that as very likely.
Well, you guys mentioned the Canadian player who's moving in. Let me give you a different one. I understand there's a lot more here, but one of the things that really struck me here is the importance of the warranty. Berkshire Hathaway buys a competitor and says, we're going to guarantee the warranty for the next 20 years. All of a sudden, you've got like literally, the only AAA credit out there who's guaranteeing the warranty. Would that scenario worry you guys at all? Or would you just say, hey, I mean, Berkshire, I actually think the history of the companies run underneath them is they actually get a little bit sloppier and everything. But I was more thinking of it just from the warranty guarantee. Now, all of a sudden, you're going up against the gold standard of we will be there. We will make sure this gets replaced.
Yeah, Andrew, I'm very excited for this question because if you think about the top four players, the number 3 player is owned by Berkshire Hathaway.
Oh, I did not realize that. Okay.
We bought them in 2000, and even they, despite the, I guess, impressive track record of Berkshire, they actually struggled to keep up with Carlisle's track record, despite being within that umbrella.
Who's the number 3 player that Berkshire owns?
John Spanville.
Oh, I should have known that. Okay. I probably was
So
just...
we have this on our slide 3, and then we show kind of the actual margin difference.
What's that slide number? That's a good one.
I'm trying to find it.
It's in the appendix, a couple slides in.
Okay, I must have missed it. Last one. Last question, and then we can wrap it up while I try and find that John Mansville one. When I was researching this, and when I was reading the Q1 call, one of my first things was, labor shortages, right? A lot of migrants come in and do construction. I think that's more resi than commercial, but I'm sure it's very much commercial as well. Labor shortages. You guys have obviously analysts are concerned because I think there were 2 questions on it in the Q1 call. The company is concerned. You guys had kind of a different view on labor shortages and how it might actually benefit them. I think you talked about it a little bit up front and when you were talking about going to the industry conferences, but I know people are going to be thinking labor shortages. I'd love to just hear how you think like that's a very contrarian view that it could benefit them instead of hurt them.
I guess one thing to note really early on is that this is like very highly skilled labor. You can't just get any contractor to come in and do this type of work. I think Tuan mentioned it. Like this is something you have to be certified for to even be able to install Carlisle product. We interviewed a lot of people at the trade shows that we went to, and most of them were smaller contractors. And so these are the guys that are the closest to the labor constraints. And all like on average, I'll try to not speak too broadly here for Dimitry, but on average, what I was gaining from the questions I was asking was backlogs are not really different. Like they're not worse than they were last year. If anything, they're slightly higher. New project bids are not challenged by or constrained by the ability to find labor. And all else equal, their expectations are flat to slightly positive for the year ahead. I'm not sure if you guys have other things to add, but
yeah,
that helped us become a little contrarian.
Andrew, when you asked what would keep me up at night, I think the labor risk may be one of the few things that could keep me up at night. I mean, labor has been tight, is tight, and has been tight for many years for this industry and for other trades. Now tack on to that the immigration policies that this current administration has. We don't know. When we asked and talked to industry folks on what percentage of roofing contractor labor is, illegal immigrants. It's hard to say, but is the part that gives us a bit of comfort, and maybe Erik touched on this a bit, is that the contractors that are able to install Carlisle product are, for the most part, established. Many of them are very established players, larger players that have been installing product for to some extent decades, and they've built a very strong book of business, recurring book of business. And so if we were to see an environment where the aggregate labor force in this industry is constrained or reduces, I think at the margin, the players that would get hurt the most are the smaller players, which have, installers that are less experienced perhaps have a less track record.
Starting with my interviews, that was the segment we were really trying to disprove the thesis on. And if you can extrapolate that up, it really only gets better.
Just last question, like party shot question here. Maybe not party shot because this is the party shot, but the company is running, let's call it 2 billion of debt. They're doing more than 5 billion of EBITDA every year, if I am remembering off the top of my head correctly. Uh, that's a pretty lightly levered balance sheet. They read The Outsiders. I haven't read The Outsiders in a long time, but John Malone jumps to the top of my head. A lot of people, The Outsiders tended to run with a little bit more leverage than this. Do you think the company should lever up a little bit? Does this company belong in private equity hands outside of public markets? Like, do you think they should be a little bit more? I'm not saying to take it to 10 times EBITDA, but do you think they should be a little bit more aggressive, run a little bit more leverage to amplify what I think is a pretty darn good business?
I think the covenants, Dimitry, correct me if I'm wrong here, but I think it's something around 3 times that they're allowed to.
When they do M&A, they've been willing to go up to around 3.3 times. And I'll let you continue, Erik.
They can flex up as necessary. I think they're not trying to flex up to buy back stock. They'll use internal cash flows for that. But in the event that they find another Henry, definitely.
Do you think they should? Definitely hear you on the acquisition, but do you think it's too conservative? Is kind of what I'm asking, right? Again, they don't have to run 3, but I think they're running less than 1 right now. Should they just be, kind of it's not in vogue right now because you can look at the charter stock price, but hey, we run this 2 times levered. Every dollar of cash flow, we buy back stock. If our EBITDA grows, then we can buy back, if it grows $1, we can buy back 2 because we run this 2x levered. And then we flex up to 3 for acquisitions and take it back down. But I guess I'm saying, do you think they could improve returns without commensurate risk by just being a little bit further on that leverage spectrum?
I think the short answer is yes. Is yes. But as now owners of the stock and the company as well, I think my preference is have the balance sheet flexibility for when downturns hit given the somewhat cyclicality in this business, given building products, you want to have that flexibility to be able to play offense and do big deals when everybody else is playing defense. So yes, they can have a more levered profile, but they don't need to.
I don't think there's a right or wrong answer, right? Because I'm not saying take it all the way to the hilt and you can say, hey, things get really bad, we'll be able to go elephant shopping. But at the same time, you look at the history of the stock, if they had just been able to lean a little bit more into the buyback, there'd be a lot less shares outstanding right now. And everything we've said is good business, a lot less cyclical than you think, growing tailwinds. Like that does call for, hey, maybe we need to run with better than a AAA balance sheet. Guys, this has been awesome. I guess we're going to do 2 things. A, I'm going to include a link in some way, shape, or form in the show notes to either their presentation or some way to get in touch with the 3 of them if you want to talk to them about the CSL, the research they did, what they're doing over the summer, all that sort of stuff. So I'll include that. But I guess I want to wrap it up. We covered a heck of a lot. I actually had a heck of a lot more in my show notes, but I'm going to have to stop at some point. Is there any burning thing or anything any of the 3 of you think listeners should be touching on or we should have talked about?
What do you think?
Now, from my end, we covered a lot of ground. I just want to say thank you. Thank you for the opportunity. Thank you for bringing us on. I've listened to your podcast for many years. Big fan. So this was a huge opportunity. So really excited to be on.
I appreciate you guys coming on. Congrats again, first unanimous winners. I appreciate it. I'm looking forward to staying in touch. Anytime you guys want to talk stocks or anything, I tend to buy, you guys have a compounder, good business that goes up. I tend to buy shitty businesses that apparently only go down is what I'm really looking for. But let's stay in touch and everything. And I appreciate you coming on. We'll talk soon.
Absolutely. Would love to.
Thank you.
Thank you, Andrew.
A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.